This video covers Chapter 6 of Government and Nonprofit Accounting. In Chapter 6, we are talking about debt service funds for general long-term liabilities. So, long-term debt, traditional part of a government fiscal policy, often used for capital projects, large infrastructure projects, usually looking at bond issues or bond debt that has been issued. The nice thing is that it's relatively easy for governments to issue bonds. People like to buy government bonds because they have reliable regular payments and they're considered a low-risk security. And interest on government debt is generally always tax exempt at the federal level and sometimes at the state level. Most states do have statutory limits on the amount of debt that state and local governments can issue. This is usually based on a percentage of taxable property within the area. So we know that general long-term liabilities, this is very common, similar to business, that long-term liabilities are from our own activities that create obligations for us to pay money. Okay, so we're just talking about general governmental fund liabilities in this chapter. We'll be talking about proprietary and fiduciary funds in later chapters. And then last chapter, in chapter 5, we talked about capital project funds, where bond issues for specific capital projects are accounted for, usually within that capital project fund. So these liabilities are reported in both the governmental activities of the government-wide statement, but are not reported as liabilities of governmental funds. So there are multiple sources for long-term liabilities. So we have bonds, which are just like when corporations issue bonds, notes payable, where we take out loans at the banks, and then leases. So when we're leasing something for a long term, but we don't intend to purchase it. Then we have other operating activities such as claims and judgments, pensions, and environmental issues. So pension activities we're going to talk about in a later chapter, and claims and judgments and some environmental issues are very briefly talked about, but we're also going to talk about in a future chapter about things like waste management and different things that governments have to do where they have to save money for environmental impact on like landfills and stuff. So they have to have money saved aside to basically deal with the landfill once it's full in an environmentally friendly way. Pensions are an obligation, of course, to cover retirement of employees. A lot of states historically had defined pensions. Many still do have defined pensions, which of course have different, you should have learned this in intermediate, or you will be learning it in intermediate this semester, about how pension accounting is very different from like 401k accounting, which is just a salary obligation. And then claims and judgments. So is the city currently under a lawsuit? Have they lost a lawsuit? Are there claims against them for various damages or things like this? This can include environmental damages. So there can be environmental damage claims against the city in addition to claims from private citizens and various lawsuits. So we have to, of course, recognize our long-term liabilities. we record it in the governmental activities records at the government-wide level, even though the proceeds may also be recorded in a governmental fund. We can also have a debt service fund. Long-term liabilities are recognized in proprietary funds and private purpose trust funds, but we're going to talk about those two types of funds in different chapters. You can also see where long-term liabilities recognized by like a capital debt fund or a capital projects fund that we look like at in chapter 5. We have to disclose of what our long-term debt is. So governments have to prepare a statement every year stating what changes have happened in long-term debt, including additions to long-term debt, so new issuance, and payments of long-term debt. They also have to provide a schedule of principal and interest due in future years. So this provides useful information to the users about the financial statements, about what their debt obligation is. Some bonds have balloon payments on them where they don't have payments now, but they have really big payments in like 15 to 20 years. And so knowing that a government is going to have this huge payment due in 10 years or 2 years or something is very important as part of a debt issue, especially if you're a company that's looking on loaning a government extra money. Okay. If the debt is recognized by a proprietary fund or a private purpose trust fund, it's also backed by the full faith and credit of the government. So this becomes a contingent liability of the government and should be disclosed in the notes of the financial statements. And so we're going to talk more about proprietary funds and private purpose trust funds in future chapters. The debt limit is that limit allowed by law to be outstanding at any one time. So if you remember on a previous slide where it said that states and governments usually have legal set limitations on how much debt that is, the name of that is called the debt limit. The debt margin is the difference between the legally set debt limit and the current amount of outstanding debt, subject to limitation. So as we talk about subject to limitation, where we're talking about general purpose debt, where special fund debt would not be included in this limitation. So fiduciary fund debt, proprietary fund debt, special purpose trusts such as that capital project statute debt that we looked at in chapter 5, those would not be included in general government debt. Okay. Governments can have overlapping debt. For example, a county could have a debt limit of 3% of all of the property, taxable property assessed within the county limits. And then a city and a town within that county can also have the same amount of debt, limited to the amount of city. So this is called overlapping debt, where different entities within the government have debt limits set on the same asset. So in this case, property values of assets within those city limits and county limits. Because the city and the town sit within the same county, that is debt that is against property within that county. So it's overlapping with the county's debt on the same assets. So debt service funds are what we're going to talk about, really focus on in this chapter, which is a special fund that just is used within the government activities fund to keep track of all of the long-term debt. Governments can have multiple debt service funds, and sometimes they will, dependent on the size of the fund. Sometimes they will just have one debt service fund in which they're tracking multiple bond issues. So some debt issues may require lump sum payments, which I talked about. That generally requires something called a sinking fund, where we have to save money against that future lump sum payment, which is often also called a balloon payment. One example of this would be term limit bonds that come due on a certain date versus bonds that issue payments every 6 months. Okay, so of course our debt service fund, both recording, budgeting, and accounting, so we can plan and manage the repayment of long-term debt. We're going to look at some journal entries for debt service funds, and all of the examples for this chapter are related to debt service fund accounting. Interest payable is not accrued in the debt service fund. It is recorded at the government-wide level. So we have two different kinds of bonds. We have serial bonds and term bonds. And within serial bonds, there are 4 different types of bonds. So serial bonds, we have regular serial bonds, deferred serial bonds, annuity serial bonds, and irregular serial bonds. The difference between these serial bonds is really when those payments of principal and interest are recorded. But the thing that all serial bonds have in common is that they are paid back at regular intervals. So whether that's yearly, every 6 months, so a regular serial bond would pay interest, have payments, regular payments every 6 months. An annuity might be every year. A deferred serial bond might wait 5 years before they start making regular payments. And then irregular serial bonds don't have a regular time clock. Where term bonds are those balloon payment bonds where they're due on a specific date. The danger with term bonds, or that there's a advantage, disadvantage with term bonds for government entities and even colleges and universities, as we'll see in later chapters once we're past city government chapters, is that they can issue these bonds and then they won't have payments for like 20 years. So they issue bonds, they get the cash, and they don't have to pay those back for 20 years. So they don't have 20 years of payment obligations. However, they do have a payment that happens in 20 years that they are responsible for paying all of it at one time. This can cause financial burden if the entity is not recording to something like a sinking fund, a bond sinking fund it's called, where we're recording to make sure that we have enough cash on hand when that payment comes due. Okay, so this is an example of accounting for regular serial bonds. We have the debt service fund, where we're recording our estimated revenues, our other financing sources, and the appropriations that we've tied to it. And then we have the sale of bond, which when we receive cash and record bond revenues. In the governmental activities, then, we would see cash and then general revenues. This says sales tax restricted for debt service. So in the case of this fund, which is detailed even further in your chapter 6 of your textbook, this particular fund has a special assessment set on it where there's a percentage of sales taxes that are being set aside to pay back the bond issue. So that's why it says general revenues, sales taxes restricted for debt service. Company or governments can use other things. We can use property taxes, so setting aside a certain percentage of property taxes. Sometimes we'll agree to a short-term levy for a bond issue for a special project. Those require voting by the citizenship to approve. We're going to go through an example also where we look at these journal entries for an example. As I said, these entries are detailed further in your accounting textbook. Okay, and then for year 2, and then this is an example of term bonds. Term bonds that require a sinking fund then require governments to save that money as they accrue it to be available when they make that long-term payment. So as you will see, everything here is where we're looking at the budgetary values that are put in and the amount that we're receiving. So here we're looking at taxes receivable current, recording revenues. We have estimated uncollectible current taxes, and these are property taxes that are restricted for the repayment of that debt service. Okay, so we see further term bond, and of course these journal entries are detailed further in your reading. So I know this video is already at over 15 minutes. I just have a couple more slides and I would rather keep going and just post a little bit longer video. You can of course skip, watch it on speed, whatever works for you. Okay. We have to, of course, financially report for debt service funds. It's part of the governmental activities at the government-wide level. If it's a major fund, which is dependent on the amount that it is, it needs a separate column. Otherwise, it's included in the last column with all other non-major government funds. Of course, they also have to disclose the schedules of what debt was added, what debt was paid off, and what future payment schedules are. The resources held in debt service funds are generally invested in low-risk securities. So when we receive revenues for future payment of a debt service, those get invested in low-risk securities, and the any gains or losses, interest received on those is all recorded in changes of fund balance and in the statement of activities at the government-wide level. These types of investments are recorded in the accounting records at their fair market value and are adjusted yearly to the current fair market value. Risks, of course, related to deposits and investments held at financial institutions. So we have interest rate risk. So the chance that the interest rate will change significantly and we're locked into an unfavorable rate. Of course, we can mitigate this by refinancing debt at better rates. So we also have custodial credit risk, and concentration risk. So these risks are, part of just general investment risk. We have to disclose. So this is deposit and investment disclosures. So when we have these investments, we need to disclose them, including what are the legal and contractual provisions for them. So for example, that if we have investments that are set aside specifically related to paying off a serial bond or a term bond in 20 years, that needs to be disclosed in the notes of our financial statements. We also should provide disclosures if there are any specific types of risks related to that. Okay, lease payments. So lease payments are when we have a long-term lease obligation, but we're not purchasing so we're renting a building, is a great example of what a lease obligation looks like. It's an annual payment. They're installment payments of general long-term debt. We can use multiple funds in which to record that. It really depends on the purpose of the lease. So if it goes in the general fund, a special revenue fund, or a debt service fund. We're going to look at an example, a lease payment example, as part of the examples video. Governments can also do what's called debt refunding. So these are bonds that are issued to retire previously issued bonds. Generally, this is done when there's a significant interest rate change. So the interest rate on the new debt is much lower than on existing debt. Well, so of course, when inflation occurs, then our interest rates change and we can get into periods of really high interest rate obligations. So it's good to basically refinance. Other reasons that we might do this are we aren't going to have sufficient money to pay back. So we don't have enough money in our debt service fund to repay back our bonds when they become due. And so what we're trying to do is issue new bonds. And then we could have covenants on existing debt that are excessively burdensome. What a debt covenant looks at is this is a rule about, things like you can only take out so much debt as long as this debt is outstanding. You have to maintain a permanent balance in a bank account of this amount. So covenants are requirements on the debt. They can be anything there based on the legal agreements. We can also do advance refunding of debt for various reasons. Okay, so that is looking at Chapter 6.